Hello, hello. Welcome, everybody. Good to see everyone today. Some of you for the second and third time. Well, you are in for a wonderful treat. We have another bonus hour for you guys. Guest speaker, Dan Kalis. He is one of Roland's business partners and a valuable member of the Epic community. Before we let everybody in, we were reminiscing about TNC 10 years ago. So that's how far back it goes. I'll be here in the background to moderate the chat as always. If you have any program related questions, hit me up. And Dan is going to talk about deal funding with you all today. Definitely want this call to be Q&A driven, so feel free to raise your hand at any time and we will get you called on and all of that good stuff. So Dan, I will go ahead and turn it over to you, sir.
Thank you, Michelle. All right, can you guys hear me okay? I got a fresh office set up. I was just telling Michelle that I just moved from the Denver, Colorado area to the Phoenix, Arizona area, Gilbert, actually. I know there's a few of you in this area that I've already connected with, so we'll get to meet in person soon. So my home office, my bookshelves are blank, but my brain is full, and hopefully we'll be able to get some good stuff out here. I do have a document that I can run through an outline. So when we talk about, so Dan Kalis, FullyFundable. I've been in kind of the business funding and credit side of the business since 2010, right after all the mortgage industry stuff collapse happened, which I was in that industry. So I've been in finance for pretty much my entire career, which is ironic because I always say when my K through 12 in college, bachelor's degree, I was not a super academic student, definitely didn't thrive in math or anything like that. But then you end up being in financial services, and when it applies to something in your real life that you can make money and create a great lifestyle, we tend to learn and adapt and do all that. So I'm sure a lot of you can relate with that. So I'm going to try my best to make a topic that is sort of dry in terms of, we're mostly talking about SBA financing, Small Business Administration, because everyone here is taught, what's up, Jeff? Everyone here is taught creative deal making, seller financing, doing all these different types of things. The angle that I'm really coming at here is how and when and why to use the SBA 7A program, particularly. I'm not going to get into anything really with the 504. Some of you have heard about that. There's a lot of what I have found from talking to a lot of growth-oriented entrepreneurs, whether they're acquisition entrepreneurs or just growth-oriented business owners that want to get working capital or want to roll up other companies. There's not a lot of knowledge. There's a lot of misconceptions. There's a lot of things like, for example, SBA 7A loans are not loans from the SBA. Some of you know that, some of you may not. They're always with a bank or a lender that is authorized to issue SBA loans, and it's backed and guaranteed by the federal government. And so sometimes you have situations where you've talked to a bank or you've talked to a lender and they've made a claim and they've said, well, we can't do that because that's an SBA policy. The SBA has what's called an SOP. It's a little differently than the way that we as entrepreneurs think of SOPs, standard operating procedure, although that is what it stands for. It used to be like 1,000-page document, like the Dodd-Frank legislative document. It's been shrunk over the course of the last few years, and every time they update it, to 400 and something pages. Now the last update, which was toward the end of 2023, to 200 something pages. So I figured I would just read the whole thing to you guys out loud. Is that cool? Just kidding. I'm not gonna do that. That would be terrifying. So there's so much in there, and there's so much that is up for interpretation that it's not always cut and dry. And my point earlier was that you may have talked to a lender or a bank and tried to get pre-approved or try to get a deal that you were looking at pre-approved, and it was really frustrating. You didn't understand why they were saying things or why they were asking for some things. And a lot of times what happens is they might end up blaming the SBA and say, that's an SBA policy, sorry. When in reality, either they were doing it by accident or on purpose, AKA lying, and saying, and not taking the blame. And so, it takes some experience to kind of sniff that out. It's the analogy I kind of use is way back in the day when I didn't know what I was going to do for a living and I was in between jobs and I was in my 20s, I would wait tables and work in restaurants. And if you've ever dined at a restaurant and your order gets royally messed up, sometimes the waiter will blame the kitchen. And in fact, it was definitely them. They forgot to put in your order. And the same kind of thing happens. And so when you're dealing with lenders and banks for SBA loans specifically, or really any type, you're going to have a different experience every time. The SBA is the SBA. It's kind of like if you're advertising on Facebook You know, you have maybe an agency helping you. Well, your experience with running ads on Facebook or Instagram or anything is going to vary, right, by who's helping you do that. But really, the algorithms and the platform and the settings are all sort of the same. So my role in kind of what I do is I'm a broker. So, I mean, I like to think of myself as more than a broker. I'm an advisor, I'm an advocate. My attraction to the Epic community is because people come to me for funding. They come to me for money for different things. And so I'm ultimately going to be elevating my business to where people are coming to me for funding. Yes, I can get them SBA loans. I've become somewhat of an expert in that, but ultimately it allows me to invest in businesses, allows me to acquire businesses. So it really fits sort of hand in glove. And to the degree that I can be a resource to all of you, I'm happy to give out my direct number and my email. And every deal is a little bit differently. So I'm happy to help with that process. So without any further introduction on that part, I'm going to pull up my screen and just sort of go through some basics, because I have to assume just from conversations I've had that maybe some of the basic stuff isn't necessarily known. So I'll try to whip through this, but as quickly as possible within the next maybe 10 minutes. I just want to get into a Q&A because I'm sure some of you may have like a specific deal scenario. I'm happy to go through those today. I think that would be a good use of time. So kind of the Gary Vee style of, hey, I'm just going to jump into Q&A as quickly as possible. So does that sound good to everybody? Unless anybody has any like major sort of questions or thoughts or something that you want to get me to get through right out of the gate. While I'm pulling up the screen, feel free to blurt out and let me know, but otherwise I'm going to continue on with that. All right, can everybody see my screen? All right, cool. All right, so I always kind of like to say this. I'm a little bit of a rabble rouser, if you want to call it that. I don't really genuinely, oh no, I do love the government. I love the federal government. They're there for us at all times. They're only there to help us. There's never any issues where they wouldn't be. But to the degree that the federal government is not on our side, the SBA is probably the only federal agency that I think is doing really great work, at least relevant to me and most of you. And so I think that the SBA 7A loan program is fantastic. I think it's underutilized. I think it's misunderstood. And it's part of the reason why I have, really tried to get to know it very, very well over the past few years. I haven't always done it in the scope of what I've been doing. So let's just say that this is at least one program that the federal government has right. And so to get into kind of, if you're going to be doing any sort of business acquisition financing, you really have three sort of major categories. You have cash. You could pay all cash for the business, obviously. You could do seller financing. You could do a combination of those two. Or you can do an SBA loan with some cash, or some combination of all three. And we can get into these a little bit more specific, maybe if we're talking individually. But really, there's no hard and fast numbers, but I would say at least 80-90% of all small business acquisitions are financed with SBA 7A loans. And, you're talking more, I don't know, like out of the scope of everybody here on this call, if you're all looking for more virtual type businesses, or you're doing more local based, you're buying little restaurants or HVAC companies versus kind of an e-com or an information products business. Up until a few years ago, most SBA lenders that you would work with would really only be accustomed to working with those more Main Street local type businesses. If you were to bring them a SaaS business or e-com, they would kind of like look at you sideways, like their underwriters don't know really what to do with this, or they would be applying things to the loan qualification that weren't relevant. If you're 100% virtual, it shouldn't matter that the county that you live in and that your business address is, if it's your home business or something, has a high default rate on that industry. But still to this day, there are some banks that would apply that sort of algorithm, and then you run into problems. Where I kind of come in is really being that advocate and helping the bank understand, like, it's not something we need to incorporate. And so, the service that I provide from that standpoint doesn't cost my clients really any extra money because the lenders pay me. So it's just kind of nice to have somebody who can bridge the gap between the old school and the new school. So again, why use SBA? The great majority of business transactions are done that way. So if you're dealing with business brokers, you're dealing with attorneys, you're dealing with anybody who could get into the deal to sort of trip you up, or to, of course, there's no professionals that ever do that, right? I mean, business brokers are always a blessing, never a burden. And so you may have some that will say, well, we don't want to sell this using SBA. It's kind of like some home sellers have realtors that would say, we want to sell this all cash, or we don't want an FHA buyer. You know, they have it in their head that they're stuck in a certain way. If any of you guys are working with me on getting a deal looked at and kind of, you know, the initial sort of fundability due diligence, what I'll get into in a second, and you're getting resistance from the seller, from the broker, from an attorney, from somebody, I'm happy to step in and be the person who needs to kind of be assertive with them. So you don't really have to do that and say like, look, you're being kind of unrealistic here. This is, you know, so I can be that sort of buffer. And so the industry of M&A professionals is used to that. They might be a little bit apprehensive in some ways. And, you know, people hear horror stories. Sometimes it's like, well, you know, this deal with Wells Fargo that tried to finance a deal took 6 months to close. Well, I got to tell you, that's the exception, not the rule. Really, any type of kind of full-scale SBA loan that goes from, say, $500,000 to $5 million, which is the current cap, is going to take about 60 days unless there's some extenuating circumstances. But what's nice is with SBA loans, and I'll get into in a second, all SBA loans are either 10 or 25-year amortizations. And so they're longer amortization periods than you typically will get with seller financing. Sometimes sellers don't want to wait, you know, more than a couple of years, but, you know, it really kind of just depends. But you get a long amortization period, and some of the better businesses, unless they have some really advanced sort of tax planning strategies, why they want to do seller financing to defer their tax burden, they're going to want as much cash up front. So if you're having a little bit of an issue with providing your own cash or investors that you have, this is the way that they're going to get paid the most amount at closing. It's going to be the most appealing to the seller. So here's just some of the basics I'm going to whip through. SBA 7 loans are issued by an authorized lender backed by the SBA. They're not the only loans that are from the SBA were the EIDL loans, the disaster relief during COVID. All are 10 or 25 years. The 25-year term loans are when there is either so it has to the loan itself has to be at least 51% owner-occupied commercial real estate. Everything else being equal, if you're buying a business that includes commercial real estate, it's going to be a lot more, the lender is going to look at it a lot more favorably because now you have collateral built in. And contrary to what some people may have heard or experienced, not all SBA lenders are going to require collateral, hard collateral. There are a number of them, and the ones I work with specifically are willing to look at just, hey, does this thing cash flow really well? Do you have decent personal credit? And because the only form of collateral that really matters to them is real estate. Yeah, there might be accounts receivable. Yes, there might be inventory, but that's not really good collateral. So if at least 51% of the dollar amount is owner occupied, and by owner occupied, there's another 51% rule, meaning 51% of the property itself is owner occupied. So that's by square footage. So if you're buying, so you couldn't buy like an office building where you have like one little suite and then there's 10 more suites. That wouldn't work out. It's not intended for investment, but we can get into that more later. Maximum loan amount it used to be total per person who's guaranteeing the loan, 5 million, and then you're tapped out. They recently made a switch where it's based on the NAICS code, the NAICS, North American Industry Classification System. So you can do up to 5 million per NAICS code, like the general code. Again, if I talk to some of you individually, we can get into like how we kind of work that out, because many of you probably maybe already have SBA loans on other businesses, and we can talk about how that would affect any other additional ones. SBA 7A loans can be used for business acquisition, commercial real estate, equipment, inventory, or working capital. And as far as I know, all of those 7A are variable rate. If you've ever heard about a prime or a fixed rate SBA loan, it's probably the 504, and it's very specific and different. It almost never gets used for business acquisitions, as far as I know. And the rate is based on prime rate, which is Wall Street Journal prime rate. If you go to WSJ.com, you can scroll down. Prime rate is currently 8.5. As probably all of you are fully aware, rates have only gone up over the past, basically 3-4 years, and they've been stuck at 8.5. So it's usually prime plus about 3. Maybe it's going to be a little bit lower, but 2.75, 3.5. So right now we're sitting at about 11.5%. Now that might seem high, And it especially is high if you're comparing it to something like a home mortgage or something, of course. But the reality is that when you spread it out over 10 years or 120 months, I'll get into an example of how the payments look. It's not too bad. On any SBA loan for any purpose, any person who's a 20% or more owner needs to be a personal guarantor on the loan. So if you ever hear me or anybody else say PG, personal guarantor, all that really means is that if you fall behind on a loan, you ghost the lender, you never talk to them, you aren't willing to, like, you'd have to literally ghost them for like 6 months. They don't want to default on or create a defaulted loan, because that makes their rating with the SBA go down. So they're going to try every effort possible, and they have workout departments to do this. But if for some reason that happened, then they would come after you personally per the contract. But guess what? Even if you found some sort of loan that was non-recourse or non-PG of any kind of business loan, and you default, they're going to sue you anyway. Like, it's kind of more a protection for the investors at the bank and the depositors and things like that. So 20% or more, if you are doing like multiple acquisitions where you don't want to hit the cap or you don't want to have to PG on multiple loans, try to set yourself up so that you have less than 20% equity in the deal. Like, I would imagine if we were to look at Roland's portfolio, he probably doesn't have more than 20% of a lot of the companies, and a lot of the companies he's probably an investor in do have SBA financing. But do you think Roland wants to personally guarantee 10, 20 different SBA loans? No, he does not. So that would be a way to avoid it personally. I'm going to go through the basics here, and then I'll ask if anybody has any questions before I get into some other things. Typically, as far as the down payment goes, if you talk about leverage, the SBA loan program allows you to get up to 90% of the purchase price. In the lending world, they call it project cost. That just basically means the full purchase price plus if they give you some working capital on top of that. It was always 10%. There was really no way around that. You do need to show, amidst the buying group, whether you're an individual or a group, you need to show that you have the liquidity on your personal financial statement of at least 10%, but it could be lower. And here's an example. This just happened recently, at the end of 2023. The SBA requirements said if a seller financing note is created, let's just say if it's a 5% note, you can apply that 5% and cut the 10% in half. Okay. Now, if you do that, if you're applying seller financing to your cash injection or equity injection requirement, then the portion that you pay to the seller needs to be on what they call full standby. Just means you can't make payments to the seller on the note for 24 months. Used to be the full term of the SBA loan. So imagine how hard that would be to sell to the seller. Hey, like, we have the seller financing agreement, but I can't give you a dime until 10 years go by or until I pay off this loan. Now it's only 2 years. And you can get it down to 2.5%. If the seller financing is at least 7.5%, you can get it down to 2.5%. So that's pretty awesome. It gives you 97.5% leverage. And like I said before, commercial real estate inclusion always strengthens the deal. 60 days average time frame. Before I go any further, I just went through all the boring basics. Some of you may have known a lot of stuff, some not. Does anybody have any questions of like the very basic stuff? While I take a sip.
So Dan, it looks like Paul does, and just FYI, there are like a couple questions in the chat as well.
Sure, I can take some questions now. It's fine.
Cool. Hey Dan, thanks. This is awesome. So if you end up trying to acquire less than 20% of a company, then you don't have a personal guarantee. Is that correct?
So, okay. Yeah. Cause so if Paul's asked, so I haven't even gotten into this yet, but it used to be for a long time, you had to purchase 100% of the company. You couldn't do a partial acquisition of 20%, 50, 80, whatever. So if you wanted to get the SBA loan to purchase 15% of the company, then I haven't actually had that scenario come up yet, because this is like within the last year that they even started allowing that. If you did that, then the seller, the current owner, would have to PG, because they would be obviously at 80% or something like that. They may not want to do that. Whether we could get a lender to say that you as the acquirer didn't need to buy that much, because yeah, there isn't really a minimum. It's not like they say you have to buy at least 20%. At least I haven't run into that yet. So I think that the ultimate answer is I'll have to get back to you on that, or get a specific scenario, what we're looking at on that. That's a pretty advanced question. I appreciate you asking that, but I actually haven't seen that yet, because this is kind of a new thing that they're even allowing that.
Okay, no worries. Yeah, I was just curious. I don't have a
I'll make a note of that though. No, but that's a very savvy question.
Cool. Thanks.
Next, we have some other questions, right?
They're in the chat. Would you like me to read them out to you?
Yeah, go ahead.
Derek, how hard is it to refinance an SBA loan if rates drop?
Good question. The SBA itself does not technically allow a refinance of another SBA loan because of, well, two reasons. One would be essentially all SBA loans, 7A loans anyway, are at the same rate, because every quarter, based on whatever the prime rate is, it's the whole loan is going to readjust and reamortize. So if we're at 8.5, so if somebody got a loan earlier this year at 11.5%, so it's 8.5 prime plus 3. And then let's just say, October hits and then they basically drop it to a half a point to 8. Now we're at 11. There would be no point to you can't refinance a loan right now into a lower rate, because you're going to refinance it. Like if you got another SBA loan, it would just be the current rate. The second reason is that the SBA views, they kind of view themselves with this like sort of superiority complex, like all loans other than SBA loans are inferior. And so you can only pay off inferior loans. So they would never view another SBA loan as an inferior loan. So really you can use it, and I've done it multiple times, to pay off merchant cash advance debt or lines of credit or business credit cards or stuff like that. But specifically to pay off another, another SBA loan, you wouldn't need to do it, and it's not allowed. And even if you could get a fixed rate, like on a 504 loan right now, you wouldn't want to, because we're in a really high rate environment. So you definitely wouldn't want to lock that in. Does that help?
All right, a couple more in the chat, and then Val, I'll call on you. David, what are the minimum necessary docs to expedite the loan in issuance process?
If you're, are we talking about, okay, so we're still talking about business acquisition, like a pre-qualification, I assume, because it's a little different if it's just like, hey, you have an existing business and we want to get you some money, like maybe $500,000 or $300,000 or $1 million for working capital or marketing and sales or hiring and stuff like that. That's a little bit separate. I'm assuming you're only going into, like if you came to me and you said, I have a deal I'm looking at, I'm kind of in pre-due diligence, I want to pre-qualify the deal. If that's what you're talking about, that's actually the next section that I'm about to start talking about. So if it's specifically about working capital, that's a little different. If we have time at the end, I'll get into that more. So let's just table that until I get into the next one. But if there's another question, I'll answer the question.
Cool. 3 more actually, and then we'll let you continue on. Quentin, can I get an SBA loan to acquire a company in the UK?
Unfortunately not, because it's the Small Business Administration's a US-based program. The only exception in terms of any sort of international incorporation would be like first, the company that's buying and the company that's being bought have to be US-based, number one. Number two, you could technically set up an entity or have an existing entity where you have a non-US citizen or non-US permanent resident green card holder who's less than 20%. But like you could never use a non-US citizen or non-permanent resident to be a personal guarantor, because they can't effectively qualify them. The credit scoring systems are different in every country. That's one of those things where there's really no crossover. So again, if you already owned a business or you started a business and one of your partners was in the UK or Australia or anywhere really, and they were less than 20%, as long as everybody that's over 20% was US based, then you'd be fine. But but purchasing companies outside of the US, no go.
Awesome. One more from the chat, and then Val, you can go ahead and ask yours live. Sheldon, SBA 100% covered. Do you see that often, and what might be required to qualify?
SBA 100% cover. I don't know what that means.
Sheldon, are you available to hop on to give some clarification?
Yes, can you hear me?
Yep.
Yeah, so I've had a partly it's a mixed use commercial property and then residential. And so
Oh,
I've
real
had
estate.
I've had actually a friend that does investing said that he's done it multiple times. And then actually a client of mine that's a CEO of a bank said that's not possible. They do SBA and he's like, you can't do 100%. So I've had mixed feedback on it, but two
Oh,
people
okay.
that I guess, so I don't know if it just determines or depends on what you're actually using it toward, or if it's because it's more mixed with commercial as well on the property.
I know what you're asking now. Okay, sorry. So, okay, if you were just buying a piece of commercial real estate, you could get 100%. SBA 78 loan is a 100% financing, no down payment. If you're just buying only commercial real estate, if it's in conjunction with the business itself, then the 10% cash injection is going to apply, or possibly all the way down to 2.5, like I mentioned before. But if you were going to buy, say, a warehouse of something like an industrial space, for the most part, that is a type of asset class where you would be mostly owner occupied, if not entirely. It is an SBA policy and not a bank policy that if 51% of the square footage is occupied by you as the buyer, then you'd be able to do that. And then if the other 49% was like 1 suite or 10 suites, you could rent those out. But they don't want the SBA 7A program for real estate is not intended for investment at all. It's only for owner occupation. And so the other thing that is kind of dumb, I think, is that if you were just buying commercial real estate, like for example, if you were buying residential real estate like you're buying a home to be that type of real estate investor, and you wanted to run it as a rental, you would be able to use the lease if there was already a lease in place, or if you had one basically ready to go, the lender would let you use the rental income for that to cover the mortgage. In this case, it's not that way because it's just sort of secondary. So you couldn't say, I want to buy this building, and they already have 40% of the building is being rented out, and we're generating $10,000 a month at NOI. The underlying business income of the business that's the owner occupant has to be enough to cover the SBA loan on its own. Does that make sense for you guys?
Yes, thank you.
You bet.
All right, Val.
All right. Hey, Dan, thank you very much.
You bet.
The question I have is probably related to some of the questions here. If I have a situation where the owner wants to keep just under 20% equity, how does that play into the SBA loan that I might be able to? Can I still fund 80% of the value of that business with SBA loan?
Yes. The only question would become, and again, this is like a new concept, and banks are still trying to kind of reconcile how to do this properly. Because again, there's like bank and lender policies that like you can add to the SBA. You just can't take anything away from the SBA SOP. But then there's even a matter of them interpreting the SOP. They interpret it differently, just like anything, right? We're interpreting the laws of the land, we're interpreting the Bible, we're interpreting whatever. Like everybody has their own opinion. And so they're still figuring it out. The only question would be then, even if the current owner if you're buying if you bought 80% and they're still 20, they would need to personally guarantee your loan because they're still going to be an owner. If you bought 85% of the business and they weren't 20% owner anymore, I think some banks are going to require that seller, the previous owner, to still also personally guarantee the loan, even though they're not at 20%, because they still have they have a continued interest. But again, this is going to be sort of a case by case scenario. So, but as a general rule, yes, if you're buying anything, more than 20%, you definitely need to be the personal guarantor on that. And the percentages of what you can buy haven't been totally defined in terms of minimums or maximums. I don't think you could use an SBA loan to buy like 1%. That just wouldn't make sense. But something in the range of 10 to 100%. But so I can't give you a definitive answer because they're still sort of working that out. with how to interpret that, but does it answer it enough to at least start the conversation?
Yeah, no, in this particular situation, the buyer said they don't want to apply personal guarantee, so they want to take just enough equity to, get them out of that personal guarantee situation. And I was just trying to. It looks like that percentage is flexible.
I think what's going to come down to most of the time, and again, if any of you have been in the mortgage business or you've just gotten a lot of mortgage loans over the course of your life, there's something that's commonly a term that's commonly used called compensating factors. So it's like, well, this is what we're ideally looking for, but if the credit is kind of like marginal, but the cash flow or your income is really strong, we can kind of make up for that. Or if the person coming in doesn't have the industry experience we're exactly looking for, but like the debt service ratio is like way higher than we need, they'll take more of a risk. So I think if the buyer team comes in and bought 80% and they were super strong, especially if there's collateral, the bank would be less prone to say the current seller needs to also PG this. They might not require. I mean, if they have 20%, they're going to allow that. But if it's more like 15, like we said, they may just say like they don't have to. But they do reserve the right to say, you do need to. All right.
Yeah,
we'll talk.
thank you. That's helpful. Thank you.
You bet.
All right, Dan, totally up to you. Do you want to get through the rest of your sheet before we get to the other questions that are in the queue in case any of those are answered?
I don't have a whole lot more on here. So let me go through it. And then maybe if any of these questions were part of what I'm going to go over, then they can just withdraw them or whatever. So let me just keep going here. Yeah, I'll take a little break on that.
Okay, perfect.
All right. One of the things that I want to say before I get into this other stuff is that, and I had posted this in a few different acquisition groups, and I got a really, really great feedback, except for one guy who I had to block because he just always is adversarial with everybody. But other than him, I said, when you're doing due diligence, pre-due diligence, regular due diligence, and even if you have no intention of using an SBA loan to buy a business, I think that it's smart to apply SBA underwriting guidelines, even if you're planning on doing all seller financing or you just have some equity partners, because there's really nothing more thorough than that. And sometimes I've joked around and said, if you go through an SBA loan process, even for working capital for an existing business, or in this case, you're kind of like getting a free audit on your business because they're not doing a hard credit inquiry up front. That only comes later. And you're getting them to like use some of the most intrusive data collection things ever. It's like, I mean, people kind of walk away from it and go, I feel like I just like, I don't want to mean to be crude, but use your imagination. I just went through some medical procedure that was very rough. And let me get like one example. Are you guys familiar with LexisNexis? LexisNexis is like, I don't know how they do it. It must be like the FBI or the NSA or something. Like they know everything. They have everything that can happen. I've had situations where like the guy was like my age, like, late 40s, and we're doing a loan. And when he was 17 in the 90s, he had he got a citation for a fake ID. It was dropped. There was no issue. Well, that was still on his record, like that the charge was made when he was a minor. And so he had to write a letter of explanation for that. Now, is that relevant if you're buying a business to know that? No. But, if you use LexisNexis or you let a bank use that because like we're all looking, if we're looking to buy companies, the fear is that we're going to miss something and we're going to see something pop up later that's going to be problematic that we have to deal with. The bank is going to probably do as intrusive and detailed as of a job as possible to find if there are liens or judgments or a $17 county tax warrant in San Diego County that was unpaid since 2016. They're going to know about it. And the bank's going to say that needs to be cleared before we can go any further. It seems ridiculous, but it's all kind of stuff that you want to know anyway about your own business or the business that you're looking at. So that's why I always say, sometimes it's just a matter of like, bring the deal in and let the bank do their thing. And so as it applies to working with somebody like me, and we'll get into here, like what SBA fundability looks like from a qualification standpoint. You have you have the target company, that's the selling company. Well, let me start up before that. You have just the transaction details in general, which like when somebody comes to me and they go, can you help me figure out if this is a fundable deal? And I tell them what I need. Guess what percentage of the time I get everything I ask for within the first week? Almost never, right? And it's not always because the acquirer doesn't get it. It's because the seller or the broker is getting in the way and they want to send me some trailing 12 number. And I'm like, dude, like that number might be handy in some capacity, but the lender doesn't care about trailing 12. They don't care about what you perceive to be SDE. These are all numbers that we sort of use in the creative entrepreneur space, but the bank doesn't acknowledge that. So we just want to know like kind of basic numbers here. And so the business itself has to be looked at, and then the buyer has to be looked at. So if somebody came to me and they said, hey, I'm going to be looking at a lot of businesses, I'd like your help in helping pre-qualify some of these things. I may or may not say, okay, well, first and foremost, I want to make sure you're qualified as a buyer, because if I spend a lot of time, or the bank spends a lot of time saying, yeah, the business you're looking to buy is good, they like the industry, the cash flow is good, blah, 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 there's no tax, there's no liens or judgments or criminal things. But then we come to find out, like, you know, the buyer, the acquirer is not qualified. We just kind of wasted time. So I'll talk about what's going to be required there. But sometimes if I already know the person, I kind of trust them. I'll just say, I'll get your stuff later. I need your personal tax returns. I need your resume. But like barring that, to answer one of your guys' questions, the target and selling business, really what I need up front, other than the purchase, you know, an LOI or purchase agreement, something that just dictates the terms of the deal as they're currently proposed, a CIM, CBR, whatever that particular broker calls the offering memorandum. If there's a business plan and projections already sort of created, which would be more on your side. If you ever found a seller that already did that for you, that would be a miracle. Probably doesn't happen. And then if there's commercial real estate involved, we just need the basics, right? What's the address? What's the asset type? Maybe you have a lot number and then a mortgage statement and then the last appraisal. But for the target business itself, in order to find out if this thing's going to cash flow and get SBA approved, the very first number that I always need is whatever's on the last tax return. Because what I often get is some spreadsheet and some application, and all of them in different formats, and some number that says SDE and it says $1 million a year. And then I look at the tax return and it says 175,000 net income. And I go, well, how do we get from 175K to $1 million? Oh, we have add backs. You guys know about add backs, right? This is like the bane of existence of lenders when they're trying to figure out what is a viable add back, because lots of proposed add backs, and I'll get into what that is in a second if you don't know exactly, are just not viable at all. And some of them technically are realistic and they're viable. They're just not acknowledged by the banks. And then there's ones that are acknowledged by the banks. So 3 years of business tax returns. At the very least, I need the last year, in this case, 2023. If they're still on extension, which I think you can be until like October 15th, correct me if I'm wrong, someone, I think that's the deadline. Then we'll go off of 2022. And instead of 2023 tax return, I'll need a 2023 P&L and balance sheet for the calendar year. If whatever I have for 2023, I also need interim financial statements. So that's 2024 through, let's just say August in this case, July at the latest, or the longest, ideally through August. P&L and balance sheet. And these need to be matching in terms of the accounting method. If you know, cash and accrual, they have to be on the same one. Sometimes I get one's cash, one's accrual. The numbers don't make any sense. And if that's just going to create more delays. You want to know why some loans go more than 60 days? It's stuff like this. All right. So interim financial statements, tax returns, and I have a spreadsheet that sort of puts the summary of those numbers, but you may be surprised how little of the time I'll get a tax return right away. But that's the number that matters. So an add back basically is, hey, we took all these deductions to lower our taxable income. And so that number that's the net income on, say, like an 1120S, which is a tax return for an LLC that files as an S Corp, that ordinary income number, you want to get that as low as possible if you are looking to lower your taxes. But any company that's looking to sell it from an exit planning standpoint, fundability standpoint, it actually backfires on them. So to the contrary of buying, this is more of an exit planning thing for another conversation for another day. But as you're building your business to get ready to sell, you don't want to take as many deductions in the previous 3 years lining up to that, because whatever's on paper is going to be the basis for how the multiple of the net income is the valuation, right? So if the net income is 0 or you took a loss, then from a financial standpoint, financial valuation, your company's worth 0. So add backs come in and they go, well, a lot of these deductions we took won't apply to the new buyer. So we're going to add them back, like one-time expenses or personal expenses, right? And so some of these things are viable, some are not. It used to be just like CapEx, which is like if you bought a piece of equipment that wasn't going to need to be bought again for, years. Well, okay, then we can add that back to the profitability. In today's day and age, it would be also things like maybe if you spent $20,000 or $50,000 on a website or funnel build out, that was a one-time thing, and that cost was deducted, lowering the income, you can add that back. So again, deal by deal, contact me, we can go through that. But we want to see a clear indication of what those add backs are. That's going to be one of the most important things to determine if an SBA loan is going to be possible. On the acquirer side, you have the individuals. So each individual, regardless of if you start a new entity or if you're acquiring the business into an existing entity that you have, like a roll-up, or if you're actually buying their existing entity, like a stock sale. At least in the SBA financing world, an asset sale, which does not include the entity of the company you're buying, an asset sale is like 90% of the time. So it's very rare that somebody will actually buy the entity that goes with it. There's pros and cons to it beyond the scope of this call, but individual qualifications, 3 years personal tax returns from each person that's over 20%, personal financial statement. It's an SBA document that just shows they're not actually going to ask for bank statements in most cases. They're just wanting to know what's your net worth, what are your assets, what are your liabilities, what kind of salary do you have, what kind of outside income sources do you have. In the event that this business that you're buying fails to pay for itself in the interim, do you have additional income to cover the SBA loan payment? That's what they're really wanting to know. What kind of assets can be pledged as collateral potentially? What personal credit score is just going to kind of be like a verbal, like tell me what your personal credit score is. Usually a FICO is what they're going to use, some version of FICO, and then a resume. One thing that's really important from the acquirer side of the table is that a lot of us want to buy businesses and be absentee and have somebody else run the business, which is great. However, you can't tell the SBA lender that that's exactly what you're trying to do. And in fact, you can't even really do it. What has to happen is if you were going to basically count on the say the general manager or the employee non-owner that was currently running the business you're buying, you're going to keep them on afterwards. That's your plan, right? Well, there's no telling that, there's no saying that once they announce that the business is for sale, this person's going to quit and then your business is kind of screwed, right? So like you'd either have to give that person some equity, maybe 1%, maybe 5, maybe 10. Now they're an owner. And so they're the ones with the experience, but you can't just come in and go, I'm going to buy, whatever, a landscaping business, and you have no landscaping experience to speak of, right? But you just have general business acumen. You have to, somebody that's an owner, whether 1% or 100%, needs to have something. Okay. So does that make sense for you guys? And then the last part of this real quick, and then I'll go back to questions, is the SBA uses a term called affiliate or affiliates. Those of us that are kind of plugged into the digital marketing world, think of affiliate like a joint venture, like somebody who's promoting your for a commission. An affiliate for them means basically an affiliated business. Any other business of which you own 50% or more is an affiliate. So whether you start a new entity or you have an existing one you're using, if you have other affiliated businesses, the lender's going to want to see the tax returns on those businesses if the ones have been filed, because they don't want, what they're trying to avoid is that you can't get a loan on your other business. So you're trying to get a loan to buy this other business And then you're going to use that money to fund your struggling business, which is going to put the whole deal at risk, and they don't want to default on it. Or if you're just struggling and they know that you're going to be, your attention and your energy is going to be pulled away, same thing, it's going to put their loan at risk. So they just want to know that there's no major red flags with other businesses that you own. All right, before I get into some of these more specific qualification basics, oh, how many other hands do we have? Any questions that didn't get answered in the last 5 minutes?
Yes, so we have 5 hands up in about 14 minutes.
Okay, I'll
I
go
don't,
rapid fire.
yeah, let's do rapid fire. So if you could help me out, I know we both have a hard stop at the top of the
Yep.
hour, and just ask one concise question, that would be amazing.
Yep.
And Satish, you are up first.
Yeah, thank you. Dan, it's a very informative session. Just a quick question on SBA. I have a industrial land which we are trying to build flex warehouses on top of it. Is there a SBA loan, construction loan, kind of product which we could use for it?
Generally speaking, from a commercial real estate standpoint, they're not going to provide funds for value add construction. It kind of has to be stabilized and ready to go.
Okay.
But there's other lenders that can do that kind of thing. So if you really need help with that, let me know. But it wouldn't be an SBA loan, but we can talk about that separately. Just reach out to me.
Okay, sounds good. Thank you.
Awesome. And Dan, that's also a friendly reminder for you to put your email in the chat at some point, because I know a lot of these people want to snag that up.
Yeah.
And Jay, you are up.
All right, thanks a lot. So the question was, let's say if you had you were crafting a creative finance deal where the owner would still retain some type of equity in the property, in the business, but wanted to walk away with, let's say, 300,000, like you had mentioned, as far as for an existing business. So it's not for the purchase of the business, but this would basically cover you crafted it, this would cover their down payment, whatever you're asking for. What documentation would existing business need for a 7(a) to qualify for a 7(a), as opposed to for the purchase of a business, but for the existing business, where that you can get the owner there? And I know they're PG, so they would still retain some type of ownership of the business as well.
I'm not 100% sure you're asking what you're saying, but if you're saying like this is something separate from the acquisition in a purchase and sale of a business, it's an existing business, and you're just looking for, basically it's kind of the same documentation. They're going to look at the last tax return, interim financials, and depending on what the use of proceeds are, if you 500,000 is sort of the sweet spot where it's the most that you can get with the least amount of intrusion. Because if you go above $500,000, they're going to possibly require collateral. They're going to require that the owner, the bank has put on the owner's life insurance policy. There's more in-depth underwriting. But basically, and this is what I was about to get into here about the debt service coverage ratio, this would sort of apply. And I wanted to make this presentation more about acquisition financing. So if you'll reach out to me, we can talk more about working capital separately. But I will say this: if you buy a business and you're getting the financing to pay the seller what the deal is, you can often get maybe another 10% of the purchase price in working capital to get you going forward. Because otherwise you'd have to wait 2 years after you bought the business, because usually you'll have a new entity, and so it's really a startup. If you bought the entity and it's a stock sale, then you could possibly get one right away. But a lot of times you can get working capital at closing. So beyond that, we just have to talk one-on-one. I don't want to.
Okay.
Make sure.
Okay.
Good,
Thanks.
good question. Yeah. Next.
All right, David.
Hi. Well, I forgot to wear my crash helmet down. Oh my gosh. Anyway, so let's say it's a $700,000 deal. Owner's willing to finance it. So I could come in and say, you don't need to finance it. I can get 100% SBA loan. So how would that dynamic work? And would you defer to the SBA loan if there was real estate as collateral? If you understand my question.
I mean, it wouldn't affect the seller if they're not issuing seller financing. You basically just have to come up with 10%. Well, okay, so if there's commercial real estate,
Was a
as
golf
part of the,
course,
say again?
the golf course.
Golf course, okay. Interesting. So because there's a business and commercial real estate, if it's just commercial real estate, you can get 100% financing. If it's commercial real estate and the business itself, the operating business, you're still going to be subject to the 10% cash injection. If the seller is not financing anything and contributing to it, then that on that situation, you need to come up with 70,000 cash at closing. So if they were willing to basically provide some financing, seller financing to say 5% of that, so whatever, 35,000.
Yeah.
And they were willing to wait for it, then you could then your cash injection would be 35,000. Does that answer your question?
Kind of, sort of. I'll email you.
Yeah, but that's basically yeah.
Okay. Thank you.
Thank you.
All right, Tim, you are up, sir.
You're muted, brother.
Sorry about that. Thank you for this. This has been very informative, and this might actually help a couple of folks. I'm based in Canada, and so I'm looking for just to kind of, if this is beyond scope, let me know. But my first acquisition will be not including an SBA loan because it'll be too soon for all that stuff. I'm thinking about immigration with like an E2 visa or something of that nature. How much track record with like a credit history, all these qualification things would be necessary really to kind of get in there to do an SBA loan?
Yeah, good question. So first and foremost, all the other international aspects would apply, even though Canada is kind of like the USA North. But as far as building a credit profile, I've never really got a clear answer on that, no matter who I've asked, because it's not to say you have to have 2 years of credit history specifically, but it might take that long to actually get a FICO score that is going to show up, because a lot of times maybe you just started. It's like because if it doesn't show one, you might be able to overcome that, but the bank reserves the right to say, you need to have somebody else on here, right? That has a credit profile. So I would say if you have a FICO score that says 620 or higher, there's no real minimum credit score with SBA, but most lenders are going to say 620 is kind of the unspoken floor. And if you have permanent residency, I don't know if that's is an E2 is that? I know like a green card is different than E2, yeah. But whatever the permanent resident is, then you could personally guarantee. Okay. Yeah, it just depends on how easy it is to kind of get a hold of like any of your financial records, mostly based on credit. Again, reach out to me separately and we can kind of talk through some specific situations.
Thank you.
You bet.
All right, Derek, you are up.
Hi. Is it true that when you're being qualified for an SBA loan, the amount of home equity you have could count against you in terms of the amount that you could be approved for? And if so, it was suggested that you should take out like a HELOC, even if you don't use it, just to kind of offset that. Have you heard this?
Well, okay, so there's kind of two parts to this question. One, it sounds like you're almost saying, can you be overqualified because you have too much net worth through equity? I haven't really heard that before. But what I would say is, and this is more if you're getting a loan for an existing business, not an acquisition loan. If you're getting a loan for over there are SBA loans below 500,000. This wouldn't apply to, and I actually do a lot of those. But if you're over 500,000 and you have at least 25% equity in your primary residence, the SBA requires the lender to take that as collateral. If you don't have 25% or more equity, then they don't have to take, they won't take it. And that doesn't mean you won't get approved. You just have to make up for it in other ways. And you can also, if that's the case, and you have equity in a property that's not your primary residence, you can have them take that instead. They're going to try to match up the amount of equity to the loan amount, tit for tat. but I haven't heard where the amount of equity that you have would overqualify you. On certain types of SBA loans, and I don't think this would apply to acquisition, if you put on the personal financial statement that you have more than $500,000 in liquid assets, like cash on hand, which who wants to have that much cash on hand anyway? Then they would say you don't need a loan. You have enough cash on hand. So you just would want to move that money into something slightly more illiquid so that you could say you don't have that much.
But if you have a lot of equity in your home, right,
I've never
let's say
heard that would actually disqualify you. No,
not disqualify you, but maybe limit the amount that they'll approve you for.
no, not equity. Again, only if it's like you said they're not even going to check your bank statements. If you just wrote, well, I have 600,000 in cash on hand, they're going to go, why do you even need a loan? And I've had that scenario happen before, and they basically kicked it back to me and said, can you adjust this? And I'll tell them, can you just put like a couple 100,000 in like index fund or something so that it's not technically like super liquid for like a month and then put it back in cash? Yeah. So.
Okay. Thank you.
You bet.
All
4 minutes.
right,
How many more we
Dan.
got?
That's it for now.
Okay.
But let's close the doors because there'll be more, I'm sure. If you have any other pieces of wisdom to share to close this out, that would be great.
Yeah, this is one thing that's really important. Add backs we already talked about. Okay, so like again, some things to kind of look at here, like people have often said in this type of environment where there's training going on, hey, sometimes you can assume if the current business has an existing SBA loan and it works out to strengthen the deal, you can assume their loan. The loans can be transferred from one buyer to another. Most of my lender reps that I've asked about this, who have been in the SBA game for at least 10 years, have said, yes, technically you can do that. I've just never seen it happen. Because basically what has to happen is that the new person has to fully qualify on their own. So I wouldn't really rely on being able to do that if that exists. So that's one little more advanced tip. Another thing too is that you want to be careful of businesses that require special licensing or designations, like highly regulated industries, environmental, medical, daycare. You have to have somebody that is an owner, even if it's 1%, that holds that license. It can't just be an employee of the company previously. You'd have to make them an equity owner in almost every case. Technically, the SBA does not allow earnouts. There are ways around that. We could talk about that. And I just found this as part of the new SOP, and I got to get some clarity on this, but a buyer rebate where some of the money is held in escrow. It's kind of like an earnout, but really what has to happen is there has to be a set sale price at closing. Can't be variable is what the problem is. So you arrange for the certain sale price, it closes. You can keep the owner on as an employee or a contractor and give them an opportunity to earn more performance-based income. That would be one way around it. And then the other thing I was going to say real quick in my last 2 minutes is the qualification on the selling business really comes down to what they call debt service coverage ratio, DSCR. It's a common term in real estate as well. But basically, you take the net income number on the last tax return, 2023, and whatever that number is, you look at it. You take the loan amount, and you spread it out over 10 years, and I can do this calculation. Let's say the debt service is $100,000 per year. That has to be, you have to show 1.2 times that. So it'd be 120,000 is the margin. You need to have, it's 1.15, but then you're just playing really way close to the edge. So we always say 1.2. So whatever the net income is on the tax return needs to be 1.2 times or more than what the debt service amount would be. And if you don't have a financial calculator or that makes your head explode when you think of that type of number, that's where you can contact me and I'll help you figure that out. And the last thing is that the tax return is really the number. It's the official number. It's the one that's audited by the IRS. Love them or hate them, because a P&L can be modified or doctored. The P&L number in the interim year can only hurt you. It cannot help you. So if the numbers have gone down, then they're going to go off of the lower of the two numbers for the cash flow number. But again, this is all stuff. You bring stuff to me, we'll get in a flow. I'll figure out how to look at it. And we can kind of do like this fundability pre-due diligence before you spend a lot of time doing other things. So it's right at the top of the hour. I think I covered pretty much everything that I wanted to, and there's obviously more deal to deal. Here's my information again right here. You guys, that's my direct cell phone. If you want to text me, I would recommend texting me before you just call, because I probably won't answer unless I already have your number. And email
Dan,
is
thank you so much. This was an incredible amount of information in 60 minutes. I know everybody really appreciated it. Thanks again, and we will see you soon, hopefully. Bye,
all right,
everyone.
everybody. Thank you so much. Bye-bye.